To gear or not to gear, that's the question. Perhaps you are very familiar with the BetaShares ETF BGBL, or even have it as a building block in your portfolio. With the recent introduction of its geared version, GGBL, you can't help but wonder, since I am a long-term investor and quite comfortable with risk-taking, wouldn't it be a no-brainer to just take on the geared version and aim for as much return as possible? In this video, I'll take you on a journey to better understand both, so you can make an informed decision. Let's start with the ungeared version BGBL, the BetaShares Global Shares ETF. It gives investor exposure to around 1,300 companies across more than 20 developed countries, excluding Australia. It was launched on 9th of May 2023 and has a management fee of just 0.08% per annum. Very cost effective. With roughly 3.4 billion Australian dollars in funds under management as of February 2026, it is clearly a popular choice as a core global equity allocation for many Australian investors, often held alongside Australian shares funds such as A200. GGBL, the Wealth Builder Global Shares Geared 30-40% LVR Complex ETF, is BGBL's geared version. It is a newer ETF, first introduced on 26th of September 2025, and it has a management fee of 0.35% per annum. GGBL invests directly in BGBL itself, so it has the exact same universe of companies and services a similar function in portfolio construction. The key difference is that GGBL adds leverage. In other words, it introduces a borrowing to invest component. But don't worry, as an investor of GGBL, there are no loan applications, no credit checks, and no possibility of margin calls because BetaShares handles all the loan management and rebalancing within the ETF. Essentially, it's a packaged solution with an internal investment loan to boost the amount invested. Most people are familiar with borrowing to invest in the context of property. For example, it's common to put down a 20% deposit and borrow 80% from the bank. In that case, the loan-to-valuation ratio is 80%. When you are investing in shares or ETFs, that loan-to-valuation ratio is also called the gearing ratio. It's simply the amount borrowed divided by the total value of the assets. For GGBL, BetaShares targets a gearing ratio of 30-40%, which is a relatively moderate level compared with typical property gearing and with longer-standing geared ETFs on the market, such as GGUS and GEAR. Now let's translate that into exposure or leverage, which are basically the same thing. In the property example, if you put down 20% of your own money and borrow 80%, for every $1 of your own equity, you control $5 worth of a property. That's 5 times exposure or 5 times leverage. With a gearing ratio of 30-40%, you are looking at a roughly 1.43 to 1.67 times exposure or leverage. For simplicity for the rest of the video, I'm going to use the midpoint and treat GGBL as having approximately 1.5 times exposure of BGBL. Now that we know what each fund does, let's talk about returns, because that's really why anyone cares about gearing in the first place. For this video, I'm going to use some simple long-term assumptions. BGBL's nominal return after fees and in Australian dollars is 7.5% per annum. Recent performance has been much stronger, but 7.5% is a sensible long-term figure that many professionals use for global developed shares over multiple full market cycles. BGBL's volatility is about 10% per annum, based on its recent standard deviation shown on the ASX website. If you stop there and ignore costs and volatility, the back of the envelope thinking for GGBL goes like this. If BGBL makes 7.5% a year, then surely a 1.5 times geared version should do 11.25% a year, right? That is the intuitive appeal of gearing: more exposure, more return. But in reality, there are 4 things that eat into that 11.25% and bring it back down: borrowing costs, management fees, volatility drag, and the way GGBL rebalances. Let's walk through each one in plain English. First, the borrowing cost. GGBL borrows at institutional rates, which are generally lower than what most of us can get via a home loan or margin loan. The borrowing rate is set at roughly 1% above the RBA cash rate, which at the time of this video makes it about 4.85%. This interest is only charged on the borrowed portion, not on your whole investment. At 1.5 times leverage, for every $1 of your own money, the fund borrows an extra 50 cents. That means the effective borrowing cost relative to your capital is 4.85% times 0.5 equals about 2.425% per annum. And that's the cost you're paying regardless of whether the markets are going up or down. Next up is a management fee. GGBL charges 0.35% per annum, and importantly, the fee is charged on the gross assets, which is the entire 1.5 times exposure. In other words, you are paying the fee on both your equity and the borrowed portion. So the effective fee relative to your own capital is about 0.525% per annum. So if we keep adjusting our simple 11.25% starting point, 11.25% minus roughly 2.425% for borrowing costs, minus roughly 0.525% for management fees, we're now down about 8.3% per annum before we even think about volatility and rebalancing. Already you can see the theme. A good chunk of the extra return has been eaten up by just the cost of borrowing and higher management fees. Now let's talk about the third piece, volatility drag. This is a slightly nerdy bit, but it's important, especially for leveraged products. Let's start simple. Imagine you invest $1 and it goes up 10% in year 1 and down 10% in year 2. Over 2 years, the average return is 0%, yet your money dropped from $1 to 99 cents, a 1% decline overall, which translates to roughly minus 0.5% per year. That minus 0.5% is a volatility drag, the loss caused by market ups and downs canceling imperfectly over time. Mathematically, volatility drag is estimated as 1/2 times the volatility squared. So with 10% volatility drag is 0.5%. Now let's crank the volatility up by 1.5 times. Suppose your $1 goes up 15% in year 1 and down 15% in year 2. Again, the average return is 0%, but now your money has fallen 2.25% overall, or roughly minus 1.1% per year. That's your volatility drag at this higher volatility level. The key takeaway is that the higher the volatility, the more it eats into your long-term performance through volatility drag. So for our 2 ETFs, the additional volatility drag that GGBL experiences compared to BGBL is about 0.6% per annum. So GGBL faces approximately an extra 0.6% annual headwind simply because its ride is bumpier. Factoring that in, our expected return becomes 7.5%, the same ballpark as BGBL, despite GGBL taking on extra risk through leverage. The fourth factor is how GGBL rebalances its gearing. Many leveraged ETFs rebalance every single day to stay exactly at 2 times or 3 times leverage. BetaShares takes a different approach with GGBL. They only rebalance when the gearing moves outside the 30 to 40% band. When that happens, they reset it back to the midpoint. If the markets are relatively calm, they might not rebalance for quite a while. So what does this approach actually do in practice? On the plus side, it means the fund doesn't have to trade every single day just to keep the gearing exactly on target. That usually means lower turnover, so less money leaking out in brokerage and buy and sell spread. It also avoids the classic buy high, sell low pattern you see with some daily risk leverage products, where they are constantly topping up after rise and cutting back after a fall. And because there is less trading overall, there are fewer capital gains being crystallized inside the ETF, which generally helps reduce the tax drag for investors over time. On the flip side, the actual leverage you are getting will wander around a bit. Sometimes it might be closer to about 1.43 times, other times closer to about 1.67 times, depending on what markets have been doing. So it's not going to have the perfect 1.5 times leverage day to day, like the way a strict daily reset fund would. I personally think on balance, this band approach is a positive for long-term investors. It should shave a little bit of a drag off compared to some of the daily rebalanced leverage ETF, even though the exact benefit is hard to measure precisely. So higher risk, higher return, or just higher risk? With the assumptions we have used, GGBL looks more like higher risks for only a little, if any, extra return. However, that doesn't mean GGBL is bad or pointless. It just means it's very conditional. In my view, it starts to make sense if any of the following holds. First, a strong bullish view on global shares. If BGBL doesn't just do 7.5% a year, but more like 9 to 10% a year over the long term, then the leverage actually starts to shine. In that sort of the world, GGBL's return can pull ahead of BGBL by 1% or more a year. And don't shrug at just 1%. Over 20 to 30 years, an actual 1% compounded can mean significant improvement in portfolio value. Second, lower borrowing costs or fees. This could come from a lower RBA cash rate, a smaller margin above the cash rate on GGBL's borrowing, or competitive pressure reducing management fees. Any reduction in that combined cost stack flows almost directly into investors' net returns, making the gearing more attractive. Third, a period of lower volatility. If the global markets are relatively smooth, the actual volatility drag on GGBL is smaller. So GGBL is neither a magic upgrade on BGBL nor automatically bad. It can look fantastic in a strong, low rate, low volatility world. But in an average or rough decade, it may simply deliver very similar or even slightly worse returns than BGBL, with a lot more stress along the way. In sharp sell-offs and highly volatile periods, the combination of borrowing cost, management fees, and extra volatility drag means losses can be larger than the simple 1.5 times move in BGBL, leading to much bigger swings and bigger drawdowns. And because none of us has a crystal ball, it's especially important to be clear that GGBL is only suited to long-term risk-tolerant investors. And when I say that, I mean three things. You have the willingness to take high risk. You can watch your portfolio swing around and even fall heavily without panicking and selling at the worst time. You have the ability to take high risk. Your investment time horizon is long, your job and cash flow are reasonably secure, and you're not relying on this money for short-term expenses. You have the need to take high risk. You are aiming for higher returns, and a planned BGBL return might not be enough to hit your goals. I hope this has helped clarify some of the trade-offs with using leverage. Just a quick reminder, this video is for general information only. It's based on my own research and opinions, and it's not general or personal investment advice. If you see things differently or you have run your own numbers and come to a different solution, I'd love to hear it. Share your thoughts in the comments and we can all learn from each other. Thanks for watching. I'll see you in the next video.